Amazing. All right. And we are joined by two amazing speakers. We have Bryan Farley. He is the president of Association Reserves Colorado and has completed over 3,000 reserve studies and earned the Community Associations Institute designation of reserve specialist. His 15 plus years of experience includes all types of condominium and homeowner associations throughout the United States, ranging from international high rises to historical monuments. And we also have Derek, who joined Association Reserves in 2004 after earning a degree in business management from California State University, Northridge. He has since served residential, resort, and business clients across the United States, earning the Community Association Institute's Reserve Specialist designation and certification as a professional reserve analyst. In 2007, he took over the firm's San Francisco regional office, which has expanded rapidly to serve clients throughout the Bay Area. Derek combines physical, financial, and staffing expertise to guide decision makers through significant repair and replacement projects within real-world budget constraints. And without further ado, we are so excited to have Bryan and Derek speak with us, and they are going to guide us through reserve studies just generally. So go on to you, Bryan.
Excellent. Yes, thank you so much. And the way that we're going to do this presentation tonight is Derek and I are actually going to tag team it. So we're going to both go at this, but we're also going to address whenever there's a topic where we need to kind of double click or zoom in. Derek or I are going to take the lead on particular issues that pertain to our areas of expertise. So I serve Rocky Mountain areas. So we have a unique climate in Colorado, Utah, Wyoming, where one time, or let's say during the day, it could be 80 degrees, and then at night it can drop down to 25, and then it's a snowstorm. Whereas Derek has to deal with buildings that are currently leaning over. So there's always unique things no matter where you live. But the one thing that is the same is that you need money to take care of your building, right? That's the tough part. We all collectively have to get together to figure out how are we going to take care of our property. So the way that we've tried to frame this, Derek and I, the way we try to frame this conversation tonight is using your reserve study like a roadmap. So let's just say you're going on a trip, right? It's summertime, so you're planning your summer vacation, and for me, it's like we always like to go on road trips because we have kids. And so what is the one thing my wife always tells me? Bryan, did you grab the map? And I was going, no, I don't need a map. I know where I'm going. But what do I regret 15 minutes later when I take the wrong turn? I go, shoot, I probably should have plugged that in, right? That's probably my pride and my ego, but it's actually how it works in life. You need a roadmap to know where you're going. So if you need a roadmap to know where you're going, let's just say I'm going on a trip this summer, and I need to pull up my map, and I need two inputs, right? I need to know where's my starting point and where's my destination. Once I have those two inputs, I can now start moving forward, and I can know where I'm going. Now, a reserve study acts in the exact same way for your association. It tells you, where are you financially today? And then where do you need to be financially? That's your inputs. And that's what the reserve study is going to tell you very clearly. So think of that again. We're going to use that analogy as a roadmap as we go throughout this entire presentation. And particularly, we're going to discuss some of the differences between California and Colorado. Particularly, again, double clicking on that or zooming in, we're going to show how the legislative pressure has influenced reserve study outcomes for many of the associations that we work with. California has taken some different measures in the past regarding reserves, and you're going to see what that actually looks like and what the results of that is for our associations. And so, like I said, when you're on a trip, you need to take out your roadmap. You need to take out your reserve study when running a successful multi-million-dollar not-for-profit real estate corporation, which we know as a homeowners association. Your roadmap is your reserve study. Without a reserve study, you're essentially driving blind and you don't know where you're going. Now, we sometimes hear, well, your reserve study was wrong. We got a reserve study 5 years ago. Our roof costs weren't right. But that's like taking out your map and saying, hey, the map didn't tell me there was going to be a detour 20 miles from my starting destination, right? Because what do we need to do? We have to pull out our map, recalibrate. We still know where our destination is, but we've recalibrated and put a new input in for our original location. Same thing with your reserve study. Costs are constantly changing. The life of your components is constantly changing. It's going up or it's going down depending on when it was replaced or how old it is. So the reserve study is utilized as a map. But you may have heard from many of your owners at your properties, well, why would we get a reserve study? Why would you need to pay someone to tell us what we need to replace in 20 years? In 20 years, I'm not going to live here. Why should I care what the roof costs in 20 years? But see, that's the problem. If we start arguing that way, we're going to lose every single time. Rather, we need to frame the conversation as saying the reserve study offsets the annual rate of deterioration every single year so that every owner pays their fair share while they live there. So what's fair is that every single owner pays for 1 year's worth of deterioration or 1 year's of usage while they're at the property. What's unfair is if an owner moves into the property and then gets handed a special assessment. That's not right. So again, we don't want to talk about the reserves being for the future. Rather, we want to talk about the reserves as being for the here and now. Every single owner offsetting their usage every single year. For every year that they live at the property, they should then put back another year's worth of reserve transfers into the reserve account to pay for their usage of the components while they live at the property. But again, you may have an owner saying, well, why would I want to put more money into the reserves? I already pay, $100 a month or $200 a month or $800 a month into the HOA. Why is the HOA asking me for more money? Is the board president, are they just going to go buy a Ferrari? What's going on? Where's my money going to? And so sometimes it's helpful to even explain to your owners where their money is even going, right? I called it a not-for-profit multi-million-dollar corporation. So your association runs like a corporation. It needs to run like a well-oiled machine. And so every month those owners put in the cash to take care of the property. That money is going to go flow into two different buckets. The first bucket is the operating expenses. This is the day-to-day, the month-to-month recurring expenses that happen at your association. So in Colorado, that's going to be your snowplow, your landscaping, your water, your gas, your management fee. And on a per transaction basis, it's generally going to be less than 1% of your total annual budget. But if you need to do some sort of maintenance item, let's just say you need to replace a sconce light, or maybe you have a trip hazard on a concrete area in front of your neighborhood, you can just repair that as needed and just take the money from operating, take care of it really quickly. No problem at all. The other bucket that those funds are flowing into is what's called your reserve. And these are also for recurring expenses, but those expenses are occurring on a longer term time frame, every 2 to 5 to 60 years, 70 years even, right? It could be a long-term time frame. And on a per transaction basis, they're greater than 1% of your total annual budget. And these expenses are planned. They are not surprises. These are things that we need to anticipate. Okay, so maybe you already know that, but again, it's helpful to define the terms for your owners at your property because sometimes they may not know. Your neighbors may not know as much as you do. Your neighbors aren't here tonight learning about this type of stuff. So you all are basically gaining a huge advantage in the conversation of HOAs because you're the ones taking the time to learn about it. So let's go through some of the differences starting off between Colorado and California. What are some of the differences between the two states? And this is actually really enlightening for both owners in Colorado and owners in California, because you're going to see how two different states are taking a swing at this issue, which is a big issue, right? Because if you think about a homeowners association, it's essentially a small government. It's like the most direct democracy we have. So then what happens though, is that if owners aren't taking care of their property properly, what happens? Well, all of a sudden we start to get special assessments, or even we start to have buildings that fall over. So then the government wants to get involved because they don't want to see that happening. So what tracks are the two different states taking? So let's start off with Colorado. So as of today, there is really no reserve study law in the books in Colorado. In fact, the only law for existing homeowners associations, all right, That's the key term for existing homeowners associations. This is the only law on the books. And so Colorado law legislates that a community must have what's called a reserve study policy. That's it. They just need to have a policy. That policy can state whether or not the association has a reserve study, where the funding for the reserve study comes from, where the funding sources for the work in the reserve study come from, and whether the reserve study is based on a physical and financial analysis. So that's it. You just need a policy in your documents for your homeowners association. However, last month, a new bill was passed and signed into law in Colorado. So this is brand new, but this is only dealing with newly developed associations. And so the law now states that when a developer, or what they call the declarant, turns over control from the developer to the board, at that point, they need to have a reserve study completed. And that's it. That's all that the law states. They don't have to be funded at a certain level, nothing like that. It just says that you must have an independent qualified reserve study provider complete the reserve study, and that reserve study must then be handed over to the board prior to the declarant transfer from the declarant to the board. So that's it. Those are the laws right now in Colorado. However, I'm going to pass it off to Derek, and Derek's going to take over kind of the next couple slides, which talks about the California law. And you're going to see there is a significant difference. So Derek, can you start taking this part over?
Yeah, Ryan, dynamite. Thank you for passing it over to me. I'll do my best to keep up with your etiquette on the slides here. So yeah, I service Northern California. The majority of my clients are right here in the Bay Area. We go as far south as Santa Cruz area, and then as far east as Lake Tahoe. And so I'm very familiar with California law and the way that we go about doing reserve studies here in California. Slide, Brian. So legislation within California is a very mature thing, especially when it comes to reserve funding and reserve studies. The Davis-Sterling Act is the thing that oversees condo developments, community associations here in California. And they've had reserve study laws on the books for over 30 years. So since the early 90s, there was a requirement to get a reserve study, a visual reserve study inspection every 3 years. The law is kind of sort of written backwards because there's also disclosure requirements per the Davis-Sterling Act. And so it requires that you put together a reserve funding disclosure each and every year. We're going to talk about the fact that Brian and I make recommendations within the reserve study, and the board of directors gets to choose, gets to adopt what the reserve funding plan looks like moving forward. About 15 years ago, though, this reserve funding disclosure requirement came online, and it really requires boards of directors to show their cards. We made a decision, the reserve analyst made a recommendation, we made a decision, and this is how we've determined that we are going to fund reserves moving forward. The cash flow is clearly defined, whether or not you have enough funding to avoid special assessments. And if the answer is no, you have to disclose what those special assessments will be. And this disclosure needs to go out to all of the membership, and it also is included in any kind of real estate transaction. So a savvy buyer might look at it and might see that the average reserve deficit is a certain amount of money, and they could potentially even negotiate on the unit to offer up maybe a lower price for the transaction. And then finally, the board needs to approve any withdrawals of the reserve funds as well.
And is that only regarding withdrawals for projects? Is that what that's pertaining to, Derek?
For projects and the cash that comes out for the projects themselves.
So everything must be documented so that there's no funny business going on.
No Ferraris being bought with reserves from community associations. What's also interesting in California is there's this legislation, not just AB 1572 that I'll talk about here, but there's this legislation that that has persuasion within the reserve study. So what I mean by that is AB 1572 is a requirement to get rid of non-functional turf. So think of the medians, grass medians or grass lawns that kind of are leading up to a community. These need to be replaced, removed and replaced with hardscape or different kinds of vegetation. And the requirement is there's a deadline of January 1st, 2029. And Bryan, next slide. And the key is when you know and understand what your plan is, you need to communicate with your reserve analyst because we need to build in components for these projects. These weren't projects that we knew about 10 or 15 years ago because AB 1572 hadn't been passed. But once it gets passed, once you start working with vendors, you're going to want to work directly with your reserve analyst to set up the components appropriately in the study. One perk that we're seeing a lot of clients get is rebates. You can look to water agencies, municipalities, and see if there's certain rebates for doing this project. And again, you want to communicate what those rebates were to your analyst so that he can set up the cost associated with it appropriately in the study.
Right. And so these are the state legislative acts. But another thing that Derek is now going to start talking about is we're also seeing a federal interest in reserve study funding. So again, Colorado just passed a brand new law because they're starting to see developments as an issue, new developments coming in. So they want to address that. California has already had a law in the books for a while, but now a new thing that we're starting to see is much more interest federally. So Derek, tell us about the new Fannie and Freddie guidelines that just actually came out last month as well.
Yeah, so Fannie Mae and Freddie Mac are the powers that oversee lending to homes, right? It's not just condos, it's single family homes as well. But there's new funding requirements that they're looking to. So they're gonna require as of January 4th, 2027, that at least 15% of your annual budget goes towards reserves. This is up from 10%. And what I do want to say is in California, it's often not even enough at 15%. You should probably be contributing more like 20, 30, or even 45% at times. And your reserve study can tell you what that number is. But at bare minimum, Fannie and Freddie are blanketly requiring that 15% of their annual budget goes towards reserves.
And so back in 2023, so this was back in 2023, these new guidelines came out. And so this is in addition to the most recent Fannie and Freddie updates. Sorry, go on, Derek.
Yeah, that's a good point. So there were already requirements on the books, but they've updated those. And so they're looking to review reserve studies when you don't meet the 15% requirement, and it has to be dated within 36 months. They want fresh information so they can understand what's going on. Is the association fiscally and financially responsible? Do they have enough in reserves to take care of their projects? They're really looking to see if there's deferred maintenance. Are they able to take care of the projects? Or is a potential purchaser into these community associations going to be slammed with special assessment? And that's what they really want to avoid, is these needs for special assessments and putting that back onto the consumer.
Right. And so again, the point that we're trying to make here is a reserve study, it is not just a nice to have. In fact, we're finding states as well as lenders are now looking into your association's funding levels to see how well are they doing, right? So the lenders don't want to be the ones holding the bag on an association who can't pay for a normal maintenance project. So again, this is no longer just a nice to have. This is something that is needed. It's that roadmap in order to run your association well. So, so let's go through kind of what the reserve study is. Let's go through the question of, are we well-funded? Do we know if we have enough money, right? Some of these things are making you nervous potentially. We don't want that to be the case. Rather, we just want to talk about how to use your map wisely. Did anyone else see just like a red thing come up on here? That's interesting. All right. So what is the process of the reserve study? What are we actually going to get when we hire someone to do a reserve study? Well, there's 3 key results in the reserve study that you're going to get. As you can see on the screen, it's the component listing, which is the building block. The next is the reserve fund strength. And then last, the funding plan. So those are the 3 results which you get from the reserve study. So let's go through the first part, which is the component listing. So the component list is defined by the National Reserve Study Standards. So the National Reserve Study Standards were implemented back in 1998. So the reserve study standards are super helpful because this is how all reserve specialists can create a consistent reserve study for every client they work with. So if I do a reserve study in Colorado and I see a reserve study from San Francisco, I can understand it because I understand that we're utilizing the same rules or same guidelines to create a reserve study. So we can compare the association's financial health apples to apples. So the National Reserve Study Standards have a three-part test which define which assets are appropriate for inclusion and which assets are inappropriate for inclusion. And so that three-part test is as follows. Number one, is it the association's responsibility? Number two, is the project reasonably anticipated? And then lastly, does this component have a significant cost? And so when we use those filters to establish what the association has at their property, we can get a hypothetical component listing, such as you see on screen. So what's helpful about the component list is it tells us all the data very quickly. What's the component we're looking at? How long should this particular component last? When was this component replaced and how much life is left on it? And then what's the current average cost of this particular component? Okay, so that's really helpful to think about. What's the current average cost? So in this example, you can see we just replaced the roof 2 years ago, but the reserve study is still showing the current average cost. And why is that? Because remember, we need to make sure that we spread the costs equally over the life of the property so that every owner pays their fair share. So we need to reflect the current average cost so that the owners today or this year could pay their fair share of today's costs of this particular component. But the problem with our, yes.
Ryan, I think it's just really important to point out to the audience that that's the current average cost from when the reserve study was developed. So as an example, the roof currently costs $80,000 at this point in time, but was replaced 2 years ago. It was probably replaced for around $76,000, $77,000. But each year, as you revise the reserve study, you're revising the cost estimates to keep up with current costs.
Exactly. And so as you see, every year, these costs will get larger and larger due to inflation. Now, if you notice anything on the screen here, you're going to see that all these costs, the big ones, all fall within the same time frame. And that's because we find that for most associations within the 20 to 30 year time frame. So whenever your building is about 20 to 30 years old, that's where you're going to start to see all those expenses starting to coalesce. And that's really problematic because why? Reserve expenses are inherently unfair. They're very unfair. And so if you take a look at a normal association, what you're going to see is something like this, where you have a lot of years of just kind of normal, things are just going fine. And then all of a sudden, look out, we've got a massive cost that we weren't prepared for. And so the goal with the reserve study is to flatten out all those expenses over the years so that we spread it out equally so that, again, every owner pays their fair share. So Derek, is this something that you've seen with in your area?
Yeah, absolutely. I would even put another number around the 50-year mark. So a lot of the communities that were built 50 years ago are now experiencing a lot of projects that come due. But there's definitely volatility within these expenses. And if you don't pay attention, you can get caught off guard, right? So there's $2.2 million expense here on your example in year 2030, which is quite large. And you just need to be prepared for that as a community association.
Right. And that's the key element there is a lot of times I think what we want to do is just do this, like, oh, I don't think it's there, right? I don't see it. But that doesn't really do us much good, right? We know these expenses are going to occur. We can't just wish our roof didn't fail, or we can't just wish our roof was half the size. We need to face it and say, okay, here's the costs that we have. Here's what the reserve study says. How do we move forward? And that's really the next question. Do we even have enough money to take care of the property's assets? How do we even know? So the way that we can establish whether or not your association even is financially healthy or not is by utilizing what we call the percent funded. So you may have heard this term before, percent funded. Not every single reserve study company utilizes this, but we find it's a really helpful metric to define the statistical health of your association. And so the way that we do it is we take your reserve account balance, so what is in your reserves as the fiscal year start date, divided by the total accumulated value of deterioration, which is known as your fully funded balance. I'll show you that on the next slide, but we take that, divide those two together, and that gives us our percent funded. And so you can see here, percent funded is like your blood pressure. Your blood pressure doesn't mean you're a good person or a bad person. If you have high blood pressure, it doesn't mean you're bad. It just means that statistically speaking, you're at an elevated risk of some sort of problems, right? But if you're at a low blood pressure, it doesn't mean you get a gold star. It doesn't mean you're going to live forever. It just means you're at a lower risk. Okay, so that is what the percent funded is like. Now, if you're wondering what that accumulated value of deterioration is, the math is extremely simple. Let's just say we have a $10,000 product. Now, if that $10,000 product lasts us 10 years, every single year it's going to accumulate $1,000 worth of deterioration. So in year one, it's worth $1,000. In year five, $5,000. In year 10, we need to pay out that $10,000 for our component, and then we're back down to one. But if we have $5,000 in year 10, we're 50% funded, right? We're halfway there. Or if we have $7,000 in year 10, we're 70% funded. So that's how it works. It's really simple. And we'll do that math for every component at your property. And that's how we establish your percent funded. But your owners may say, well, why do I care, right? Why should I care about percent funded? And the reason why we want you all to care about percent funded is because of the risks associated with lower percent funded associations. We find that there's a much higher risk of special assessments and deferred maintenance when an association is at 30% funded and below, whereas the risk between the associations that are 70% funded and above is less than 1%. So it's a very low risk of special assessments and deferred maintenance. So Derek, is there anything you want to touch on here before I go into kind of like the arguments as to why the owners should care about not being poorly funded?
Yeah, it's really about managing the risk, right? Ideally, in an ideal world, you'd be 100% funded. You would put reserve funds to replace any kind of deterioration. That's the ideal theoretical position to be in. And it's not easy to be there, right? And so if you're not there, you should just have a goal in mind to try to get there eventually. But if you're under 30% funded, you are really underfunded and you have a high risk. And so you want to try to navigate away from being underfunded.
How do you respond when someone comes back to you and says, we're okay with being 20% funded? We can see on the screen here, there's only about a 30% chance risk of special assessment. We're okay with that. Do you find there's a huge difference between from a monetary standpoint, between an association that's 80% funded and 20% funded on maybe like their reserve transfers?
Yeah, the difference in contributions, so just what it takes to fuel a cash model from being 20% funded to 80% funded is something like 20% difference in price. So if you're funding at $800 a month or so, and you're 20% funded, if you just funded at $1,000, you would have a cash flow analysis program to be 80% funded.
Right. And that's what we find too, is the difference. Again, of course, it'd be nicer to have an extra $200 in your pocket, but just that risk mitigation puts us at a high risk position to a low risk position. And if every owner is doing that over the life of the property, everybody benefits. And in fact, it actually decreases our reserve contributions or our reserve transfers over time, because we're not constantly playing a game of catch up. We're not constantly playing behind the eight ball. We're actually getting ahead of it or keeping pace with the rate of deterioration over time.
And Bryan, believe it or not,
yeah.
There's things that are worse than special assessments, right? So,
totally.
So on screen, you have it here. So deferred maintenance, special assessments, or needing loans to take care of projects, and then lower property values. Property values are really important, right? You want to keep those elevated. And we'll touch on property values in a minute, but deferred maintenance. So on screen, what you have is you have deferred maintenance. There's weathering, there's wood rot, there's termite damage in here. And in my experience, just paint, water treatment, taking care of these issues ahead of time will save the association a lot of money. So deferred maintenance costs anywhere between 3 to 10 times more, and oftentimes actually it's even more than 10 times. And then
Right.
deferred.
And what we see though, right, is your options here is your scope of work is increasing, right? Because your small project is turning from a minor repair project into a large replacement project. And in fact, over time, you start to look something like this, right? Where you have a disorganized association. Things aren't getting taken care of. But that's not all, right? So we mentioned that deferred maintenance is going to increase the scope of work for your association. But what's the other thing that we've started to experience is massive inflation, right? And so this is Denver. This is a cost index just for Denver alone. And if you live in Colorado Springs or somewhere else, you could use it as a proxy. But you can see that's almost a 10% increase per year if you annualize that. California, as Derek knows, it's kind of the same, right?
Yeah, you can see that the cost went up significantly at about 2020, and I'm sure that everyone on the call knows and understands there was a pandemic, so there was safety protocols, supply chain issues, labor shortages, and the prices just really skyrocketed. And what makes it really interesting is our clients were playing from behind, a good majority of them. They were underfunded, and they were trying to catch up. They're trying to increase their reserve transfers and get more funds into reserves. And then the prices went up. So we're having to adjust the prices as quickly as we can, the component prices within the study, and it's putting tremendous pressure on the findings, the percent funded, and what it is that they need to set aside into reserves. So we just wanted to highlight the fact that things are getting more expensive. And hopefully they slow down, but we're not actually seeing that. We actually are noticing it, the trends of them, the prices actually increasing.
Right. Now, the thing is here, if we're just hoping that the costs go away, so we kick the can down the road because we don't want to make a decision. We don't want to tick off our neighbors by telling them they have to put more money into the HOA. You can see here, costs are going up. And so then what's the result? So in Colorado, what we're starting to see is that the majority of associations that we're working with are underfunded. You can see here, 60% of the associations that we're working with over the last year or two, there's 60% are less than 30% funded. And you can see the majority of them are actually close to 0% funded. What's your guess? If you're to guess, is California any different? Would California be different? Because again, Colorado has no law on the books. The only law that has come on the books regarding reserve studies for any associations was put in just last month. The California law, well, what you said that's been around for how long now, Derek?
1991, so 30 years.
Okay. Any guesses? You could just, take your time. Boom. Derek, can you comment on this?
Yeah, so what you're seeing on screen is almost like a bell-like curve, and the average funding level in California is 50% funded. So they have 50% or half of the theoretical figure that they should have set aside into reserves. And about 1/3 of our clients are significantly underfunded. They're poorly funded. They're playing from behind. They're playing catch up. They need to increase their reserves. They probably need special assessments. They have deferred maintenance. But the array of funding levels is significantly improved to what's happening in Colorado. You can just see it on screen. And so this is about my sample is about 1,000 clients, 944, and Bryan's was about 1,200.
Yeah, it's interesting, right? You could just see it. I didn't know. I had never seen Derek's data, and so it just shows you incentives matter, right? It helps out when you're making a decision for your association.
Yeah.
But Derek, would you mind explaining? Let's just say all the folks on here, they're doing a great job, but then someone raises their hand at the board meeting and says, "Look, we all know we special assess, right? That's just how we do things around here. Why would I want to put more money into reserves? I can manage my funds better than the HOA can, right? The HOA is not some sort of bank. I'm a pretty savvy investor. So why don't we just either special assess or get a loan? What's the problem with that?"
Yeah, we talked a lot about things being unfair. And so on this graph here, if you need, let's call it a roof, that's the project. It's a roof. It costs $250,000. If you did regular reserve contributions for a 20-year period, the roof would have cost $231,000 and change because you would have earned interest on it. And if you special assess because you need a new roof at $250,000, first off, it's more expensive, but second off, it's unfair. And then finally, another option would be a loan. You can go to an HOA bank, you can get a loan. The HOA would be responsible for the loan. They would have to pay interest as well. And that cost would be $320,000. But essentially, they have to put it right back onto the membership. The membership's the one that would actually be paying that bill. So the $320,000. So again, the best strategy that Bryan and I see is actual proper reserve transfers to fund reserves.
Right. And on a per member basis, your reserve transfers are actually going to always be the cheapest because everybody is spreading out the costs over the life of the asset. And again, the special assessment only impacts one set of owners, but it's at a super large level, right? It's a huge difference between those who had paid every single year a fair share at a proportional value. Like if it's a roof at 20 years, you're paying 1/20th of the value for however long you live there. But if you special assess, you pay for 20/20. You pay the whole thing in 1 year. A loan, you get to pay for even more than the roof because you have to pay the bank the privilege of borrowing their money. But again, someone says, well, fine, I don't care. Like, that's not a problem. I'm just going to sell my unit before we special assess. No problem at all. But Derek, what's the problem with that?
Yeah, the real estate market is becoming too savvy. They're looking at well-funded associations and the consumers, the purchasers of condo units, the lenders, they're getting involved. And there's definitely a correlation between associations that are strongly funded versus those that are poorly funded. And so a study that we did a while back, what we did was we looked at a concentration of clients that we serviced. It was actually in the LA market. And we determined that associations that are funded strongly, so 70% and above, regularly traded per square foot at 12.5% more than those that were weakly funded. And so if you do quick math, grab a calculator out. I don't know what the number is, but let's say your unit trades at $1 million. Wouldn't it be nice to get 12.5% more, when you decide to move along and sell your unit? So it's important that you're funding reserves properly so that you can get these benefits. I'm not saying there's a hard science at all, these numbers here, but there is definitely a correlation that we're seeing, some trending that supports and suggests that if you have a strongly funded community, you're doing projects on time, that you're not deferring projects, that those homes really trade at a better rate than the ones that are in poorly funded associations.
Right. And so the argument that we're just trying to make here is the percent funded is a helpful metric that we're utilizing to assess the financial health of your association. The response you may get from an owner may be, why should I care? Who cares? I don't want to put any more money than I have to into my HOA. That's ridiculous. But the response that we want to equip you all with is, well, what's our other options? Other options are we can defer the maintenance. We just showed you on a couple slides ago. If you wait one more year to do that same project that you need to do this year, just add 10% to it. It's just going to cost more. Your other option for funding that project is going to be a special assessment or a loan, which is going to be more costly. And then it's also going to impact your equity, right? So we're trying to argue here that you have to take care of your property one way or the other. So we're trying to show you the cheapest, most affordable, most equitable, most fair way are reserve transfers. That's the argument that we're trying to show here. And so that leads us to the next part is, well, where do we go from here? How much money do we need? And so this is the last result that you're going to get in your reserve study. Again, you're pulling your map out, your map for your association. This is what it's telling you. Where do we go from here? And so when we put together a reserve study, we follow these 4 funding principles. We need to make sure that there's sufficient cash at all times, that the contribution rate that we're recommending to our clients is stable, not up and down. It's evenly distributed over the life of the property. and it's fiscally responsible, meaning we're not relying on exogenous sources of income like a special assessment or a loan, or maybe that rich uncle that you know. And as you can see here, when we make a recommendation for our clients, our target is to be 100% funded at the end of a 30-year time frame. So you can see here, the goal is not to be 100% funded tomorrow, right? Over a 30-year time frame, we want to be 100% funded. But you may say to yourself, 100% funded, didn't you just tell me anything over 70 is great? So why would we want to be 100% funded? Well, again, we pull out our map, we go on our trip, and also we find out there's a detour. Do we just throw our map out and say, this map was wrong? Are you kidding me? No, we recalibrate. We say, oh, okay, now I'm here. I need to go on this road, miss this detour, and then still go on my destination. I still know where my destination is. It's just my initial starting point has changed. So the reserve study is going to have the same sort of issues. Maybe your roof fails sooner than we anticipate, or maybe your roof costs more than what we projected because they found some wood rot underneath the baseboard. So what do? So when we shoot for 100% funded, the future doesn't look like this, does it? It never does. It actually looks more like this, kind of oscillating over the years. So if we're shooting for 100% as our target, we are going to be able to withstand the storms that come our way. So we may actually not hit 100%, we may hit 80% funded. Oh man, are we bummed? No, we're actually extremely excited because we just mitigated a high risk position, or excuse me, we just mitigated a potential problem. If we were in a high risk position, we would have had a special assessment. Now we don't have to. We were able to withstand that storm because we can't predict the future. It's unknown and it's unknowable. So to put it into practice, for example, this is a recent client that I worked with. You could see here that this client got their reserve study and all they saw was this right here. They said, wow, we're 16% funded. I'm so terrified. I don't want to go to our annual meeting. I don't know what to do. So the board president called me. She was concerned. She said, are we going to have to special assess? We're 16% funded. What do we do? I said, well, no, we actually say, no, don't special assess. In fact, you can see here, we said no special assessment is needed. And in fact, we're just saying increase your reserve transfers, right? The where do we go from here? That's the funding plan. But they don't have to do that much. We just said go from 669 up to 670. They're on the right track already. This client had some big expenses in the past that they had to take care of. They were one-time expenses, but now moving forward, looking ahead, they're on the right track. So your percent funded is a lagging indicator, but your reserve transfers, that is where we're going. That's where we're headed. Okay, so that's the point of that. The reserve transfers is really where the rubber meets the road on our road trip. But again, someone may say to you, well, we can't afford that. All right. So I have found in Colorado, right, and Derek may have some other numbers that he sees in California, but I have found that when you hear someone say reserves are expensive, my response back is, well, relative to what, right? Because it's relative to what? What's expensive? Well, a cup of coffee at Starbucks, like a small drip, okay, nothing fancy here, just a super basic cup of coffee is about $3 to $5. So we're finding for our Colorado clients that it's about $3 to $5 per day to fund your reserves adequately, $3 to $5 per day per unit. So again, you may not want to give up your cup of coffee. Neither would I. Of course not. That'd be terrible for my wife. But $3 to $5 per day, taking care of my property, it's a good trade. Again, if I get to increase my equity, if I get to avoid special assessments and deferred maintenance. Derek, are you seeing something similar in your market?
Similar, but we're probably 20 or 25% higher than these numbers that you have on screen, especially in the San Francisco Peninsula market. It's just more expensive to do projects.
It is. Yeah, and that makes sense, right? It's a highly desirable area. But that's why it's good to have a local representative do your reserve study. I only work really in the Rocky Mountain areas. Derek works in the Northern California market. It's helpful when you hire a reserve study professional. It really does matter where they work, because they're the ones who are going to know the local market pretty well, be really dialed in.
Brian mentioned
the reserve.
Brian, you mentioned weather swings earlier, being in the Rocky Mountains. We have weather swings based on proximity to the bay, how far east we go. It gets awfully hot. It tends to age the components in different ways. So our analysts know and understand that. and we can calculate the life cycles slightly differently based on where the property is located in Northern California.
Right. Carl, right? Is that who comes through every summer? Carl?
It comes through San Francisco. That's right.
Yeah, I've heard about that. Yeah, exactly. Salty air. I mean, Colorado, we just have extremely huge weather swings, high UV penetration because we're so far up, we're a mile up. Like vinyl can't last. Vinyl fences start to turn into just like, I don't know, they just turn into cardboard. Like they just don't work there after long periods of time. So overall, our recommendations are that they're a recommendation. They're not an obligation. If the board does not have to follow what the reserve study says if they don't want to. But again, they paid for the recommendation. We would recommend they take a look, listen, potentially utilize it and implement the findings. But of course, if they don't like it or if they can't do it, that's understandable. So Derek, after I'm gone through with all the slides, Derek's gonna jump on and show you UPlanet, which is our version of a reserve study software program that's available for the public. Most reserve study companies offer this, or you can buy it online. But again, take the reserve study and then run it in a software program to see what works for your association, what doesn't work, right? You can start to see where the inputs are. What if we push this life back? Oh, that doesn't really have an impact. Okay, well, what if we put more money in reserves? Oh, wow, that has a huge impact. You can start to see it for yourself, which is pretty helpful. But what about inflation? How can we offset inflation? If I told you we can't predict the future, so then what good is a reserve study if we can't predict the future? Well, that is why we recommend updating a reserve study. Now, you saw the impact of California and Colorado. California is essentially, Derek, correct me if I'm wrong, it's relatively required to get a reserve study done every year due to the disclosure requirement.
Yeah, that's right. I do have a few clients that tend to try to do it on their own, and they do a site visit study every 3 years, and then they come back to me every 3 years, and so they're doing the in between years on their own. But our data supports that if you come back to us regularly each and every year, they're getting fresh, updated information to make good decisions, and thus their funding levels are 13% higher. So there's a lot of incentive there to actually hire us to come in and do reserve study and complete their disclosure each and every year.
Yeah. And what I see in my market is if you wait too long to get a reserve study done, it's not uncommon for me to see clients that I haven't talked to in 10 years say, okay, we want to do our 10-year reserve study. Now, the problem with that is, remember that slide where we showed you the costs increasing over time? Well, if you just wait 3 years to update your reserve study relative to a client who updates their reserve study every year, those who wait 3 years experience a 28% increase in special assessment risk. If you wait 5 years, you experience a 35% increase in special assessment risk. So again, updating your reserve study annually, you don't have to in Colorado, but we would just say it's best practice. It's helpful. It helps you actually offset the ongoing rate of deterioration occurring at your property. But Derek, this is the next question that we generally get. Well, how much does it cost? Right? You're trying to show us here it's important to do. You just told me that we should do it every year. Well, how much does it cost, right?
Yeah. The truth is it depends, right? So you have 3 different community associations on screen. It looks like they're all generated by AI. They're all shiny and clean and new, no problems. But the high-rise association is going to be significantly more complicated of a project for us to do a reserve study for than maybe that single-family home community, right? That's only responsible for the roadways, the green belts, the trees. Whereas that townhome community up top, that also might be a little bit complicated because you have to calculate and build out components for the balcony decks, the siding, the roofing, and the roadways, and then any amenities that they have. So the answer definitely is it depends on how much. It depends on how complicated the project is. And next slide here. And so if you're looking to get a reserve study, these are the things that we're going to want to know and understand. We want to understand what the responsibilities are. So if you have a list, like an asset list or a prior reserve study, you can send them to us. We want to know and understand if you have any concerns. So if you're concerned about the hallway carpet, let us know. If you're concerned about the roof, maybe you think it's leaking, maybe it's a big problem, maybe you're gonna have to phase it out. Phase it out, like meaning like you're gonna do it over a 3-year period. We're gonna want to know and understand that even before we get a proposal out to you. And then we want to know and understand if you have an actively involved board. It may require more time, but it also might make your reserve study that much more accurate. Remember, we're just getting information and building it into your reserve study. And Bryan and I and our team, we come on site. We might spend a day, we might spend a couple hours on site, but you're there all the time. You're seeing the issues constantly. So if you can steer us and point us in the right direction, again, it's going to make your reserve study that much more accurate. And then finally, if you want to engage with either Bryan or I, you can go to our website and request a proposal. But I also just want to point out that almost every reserve study firm has a website, and you can get a proposal from their sites as well.
So what if they do engage a reserve specialist? What are some of the best practices that they should remember to make their reserve study successful?
Yeah, it starts with communication, right? So we're a team, we're working together. We want to hear about the stories. We want to hear the war stories. We want to hear about the roof leaking. Remember, it's a visual inspection that Bryan and I are doing. If you have a prior component list, we're going to want to see that. We're going to want to understand what the history shows when the projects were done, so we can build upon that. If you have projects that are coming up, you definitely want to get apples to apple bids. So same scope, materials, quality of the roof, who the contractor is, and you're going to want to communicate that back to us. And so if you get actual proposals, get those in the hands of the analyst. Bryan and I, we have a really robust database for pricing, but the proposals that you're going to get are definitely going to reflect your community association, your projects. So anytime we get a chance to get our fingers on those, we will take that information and make sure we update your reserve study. Okay, and then you want to flag any kind of scope changes. Bryan talked about the roof leaking and maybe the plywood becoming deteriorated and needing replacement. That's something that you wouldn't know until you pull the roof off, and then you're going to be able to see how much of the plywood needs to be replaced. So that would be a scope change. And so if there are scope changes, you want to communicate that also to the analyst. Yeah. And then we talked about AB 1572, so rebates from cities or water districts. When you get those and you understand those, again, communicate those back to the analyst. And then you want to understand the next replacement cycle. So if you're replacing that non-functional turf, there might not be another replacement cycle. It could be a one-time project. And so again, your analyst and the board's going to work through that to best set up the components. And then if you know that something's coming down the pipeline, like maybe there's some new irrigation requirements using recycled water, it doesn't make sense to replace your irrigation system now with a current non-recycled water system. You should probably jump the gun, replace it with a recycled water system early, in order to be compliant when that comes due in 5 years.
So as we're wrapping up the presentation portion, the slide deck portion, prior to Derek showing you, look, you get the reserve study, now what? What do we do with it? In summary, what are the things we want you all to remember? Some of the things that we hopefully can help you think about this when you're at your next board meeting or your next owners meeting where you start to get a lot of questions. First, get a reserve study. We've showed you that a reserve study is that roadmap. It's like flying blind without a reserve study. How do you know what it costs to live in your association without a reserve study? If you don't know, how can you make budgeting decisions? So that reserve study is the first crucial step. The reserve expenses on the report, these are not something that should be a surprise. They're not things that are a surprise. These are going to occur. These are inevitable. They're predictable. Your roof will not last forever. If we defer our projects, those projects will only get more expensive the longer we defer. And why is that? Because the scope of work increases, and then inflation is going to impact the cost of those projects. And then ultimately, your owners have to pay for that cost one way or the other. Reserve transfers special assessments, loans, or they can do nothing, right? Put their hands over their eyes and say, I don't know. I think it looks great to me. Well, those are the only options they have. And so we always want to recommend that they choose the cheapest and most affordable option, right? Because the options are totally up to the board. They have a choice. Do they want to be something like this? Sloppy, disorganized, things falling apart, or again, something like this, where things are taken care of, things look nice, and there's no rumors of special assessments. And that's the argument that we're trying to make. So again, I'm going to pass it over to Derek, but if you need our contact information, we're going to send the slides out, but here's my contact information for the Colorado market. And on this next slide, we have Derek, and he handles all the Northern California markets. So thank you so much for your time on this presentation. Again, we're going to show you kind of real world examples. Derek's he put together a kind of a sample just for this presentation to show you how to walk through how, if we change some of the inputs, what results that has on the conclusions or the findings of the funding analysis. So I'm going to stop sharing now.
Okay, I think you're looking at my screen now.
Yes.
Out of the way. Okay. Yeah, so the reason why Bryan and I wanted to showcase this, again, most reserve study companies have their version of these online software tools, is because, as Bryan mentioned, we simply are making recommendations. There's more paths than we actually recommend. And so we want you to have the optionality at your fingertips to make some decisions so that you can set up your association for success. So here's the tool on screen. And for our software, it's all powered by these 5 subtabs here. So the first subtab, let me just walk you through each of these subtabs, and then we'll go in and we'll make some changes. The first tab is the component list. So all the items with quantities, life cycles, and cost estimates are here. The next tab is the control panel. So you get a starting reserve balance, the base here, interest and inflation assumptions. Then there's the recommendations tab, right? So this is what kind of fuels the future funding plan. So we have a reserve funding figure that we program in along with ramps, so increases per year moving forward. The next tab is where you can get super granular on what the reserve contributions will be each and every year moving forward. And then the final tab is all the tables and charts that you get access to. So you can make the changes and you can see what the impact is in real time. And so let's go ahead and go in and change a few things. We'll run through a scenario. Bryan, do you have any things that you can think of? Like,
well, yeah, because most of the time, what I get from a client is, look, they'll find a component that has a 0 remaining life and say, we're not going to do that project this year. Therefore, push it out. So change it, because they don't like to see a 0 on there. And that's generally what I find. But it could also just be they find an item. If you can go up, they go to an expensive item. There was one there that was like $127,000 right there. Yeah, the elevator. They say, okay, 4 years. No, we'll be good for 10, right? We'll be good for 10 years. Can you just change that? Because we don't want to do that.
Yeah, sure. I can do that. Before I do it, though, I want to show you guys. So this is the funding levels per year moving forward over a 30-year period. They're about 50% funded. I think they're 48.5% funded. And they get to about 100% funded just past 20 years. And they kind of stabilize and they kind of hum along at about 100% funded. So that's what the model looks like right now. So we'll go in and we'll change something. They call their elevator vendor and they say, hey, we're not going to do the elevator. And the elevator vendor says, yeah, you probably don't need to do it for another 10 years. But it's also not 127,000, it's 185,000. And leave myself a note. And we'll get you out of here. Nope, there you gone. Save it. And now let's see. So by changing it to 10 years, but also increasing the cost estimate, this is basically the impact, right? So they're still roughly 48% funded. and they hum along, but they don't quite get to that 100% funding level just past 20 years. They're a little bit shy. They're about 90% funded. So that's the impact. And then you say, well, what do we do about that? You know, we still want to be targeting 100% funded. How do we solve that? So you can come in here and you can either increase the initial year's funding. So instead of $5,760, you can do like 5,900. Hit recalculate, and you can see that you're starting to shape the model moving forward. But why we believe that this is a very valuable tool for board members is because you can make your decisions in real time, and you can help communicate back to your analyst, you know, what you're thinking. Maybe you want to phase out a project, maybe you need to bring on some new components, but you're able to see what the impact is in real time and get real answers. So instead of 3% for 10 years, let's do 15 years, recalc, and now we got a funding model that gets you up to 100% funded. And you can print out these tables and charts and bring them to your board meetings. And if you ever go too far and you want to go back to what the original recommendations were, on each of the pages we have these reset buttons. And we would have to come back to the component page and reset that as well. But now the elevator went back to 4-year remaining useful life and $127,000. Anything highlighted in gray is an unfunded component. Like at this community, the water heaters that were 40 gallons were each of the owner's responsibility. So we made a note within the study that reflected that. They show up softly on the component list, but they're not included within the cash flow modeling. Okay.
So again, that was just to show you all, when you get the reserve study and you say, we can't do this, we are actively trying to help our clients understand that they can then take the data, this data that we do within the reserve study, it's automatically ported onto this software. They then have the ability and the power to say, okay, well, what do we want to do? Can we do this? Where are the big drivers? And as you can see there, even if we push out the elevator project, it still doesn't really significantly impact the overall findings, because that's what we find. For most of the issues for the components at the property, it's not when the project occurs, it's actually more just a money issue. They just need more money compounding over the life of the property. It really is an income issue, not really the expenditure issue, because the expenditures are always going to be there regardless. But the income issue, that's the part that's tough. It's hard to get owners to put money in. And so this is why it's helpful, because you can actually just start to see, oh, okay, if I make these changes, it's actually, we just need more money. That's kind of the problem. So if it's okay, should we move on to the Q&A now, Kristen? Would that be helpful
Yes.
for you?
Yes, we can start Q&A. Thank you so much. That was such a thorough presentation, and I learned so much myself. I really appreciate everything that you guys shared today. So if you have a question, you can pop it in Q&A. And if you're not sure how to do that, again, you should be able to click more, click Q&A, and then you can enter your question there. If you're more comfortable raising your hand and speaking your question out loud, you can do that. And I believe if you are on a phone, you have to press *6. It might be *9. But once you press it, it will tell you if you did the right thing. All right, so we'll get started with questions, starting with Brian Boucher. And Brian, if you'd like to say your question out loud, you can raise your hand. Otherwise, I'm just going to read it out loud. Wildfire defense and Zone 0 regulations are top of mind in our association. This is for California. Complying will likely cost hundreds of thousands of dollars to address landscaping. This has never been contemplated in past reserve studies. Some board members believe this is a reserve expenditure and money can be spent immediately. Other board members are weary to spend reserve dollars for an expenditure never contemplated and believe proceeding would shortchange other reserve elements and needs. Is there a correct position on this, Derek?
Yes, so it's becoming more relevant to include defensible space within the reserve study. I do have quite a few associations that need to go out and clear a bunch of space every few years. The expense is significant, and we're adding it to the reserve study. What I when I refer to reserve studies, I refer to them as these living, breathing documents that over time need to be adjusted, and defensible space components are definitely items that we're putting into studies.
Thank you, Derek. Another question for you, Derek. Can you address different requirements for residential versus commercial?
Yeah, I think you're referring to commercial condo units. We do work with them. Um, Oftentimes, I've heard that they're not required necessarily to follow some of the rules within Davis Sterling. Um, Oftentimes, the commercial condo HOAs can skirt around some of those rulings. Um, that's my feedback on that.
Thank you. And Bryan or Derek, either of you can take this one. How do Fannie and Freddie enforce the reserve requirements?
So this is part of their condo questionnaire and their guidelines. So it's not so much them enforcing it, it's them just saying, do they meet these requirements? And if they don't, they're then either able to access these more favorable loans and at more favorable interest rates, or they're not. So for example, with the 10 to 15% guideline, when there are, so that one's particularly regarding condo associations, but also keep in mind that some townhomes are referred to as condos. And even townhomes that are like single family, I've then seen called condos as well. So it depends on how you're actually set up. So what they're going to see, first of all, if there's a loan coming through for a particular, there's a request for a loan for a particular unit, they're going to go through and say, okay, what's the checklist? Do they put at least 50% of their total annual budget into reserves? No. Oh, okay, then no, then that doesn't pass our guideline. So it's not so much an enforcement versus a checklist that they're looking at. Is that what you're seeing, Derek?
There's also a blacklist. So Fannie and Freddie have a blacklist. I don't know where it exists, but I do know some of my clients are on the blacklist. They have lots of deferred maintenance, and they've been flagged as needing to take care of these requirements. And so they're on the list, and the the homes that are being sold just do not qualify for certain types of loans. It's a big problem for them.
And there is a
Most
website that
loans.
yes, and
Yeah,
there's a
well,
website where you can go to check to see if your association's on that list or not. We actually have a link on it. I can even send that out after this.
Thank you, Bryan. Next question. Which components do you recommend planning for a phased replacement program, like roofs, rather than doing all at once?
yeah, for me, it depends, right? It depends on the association, depends on their finances, it depends on the vendor. Some communities we work with are so large that they couldn't do all the roofs in 1 year. There's not enough contractors in the world to service them. Um, but if you're, let's say, a 5 unit building, you should probably do your whole roof at the same time. You're going to get economies of scale. You're gonna have the vendor out there already. So it really does depend. Um, the non-functional turf, we've almost always set that up in phases. They know that they have so many years to do it, and those are almost always set up in phases within reserve studies.
That was good. Another person, Joseph, would like to know how their board can arrange a reserve workshop like this just for their board. So I will tell you, Joseph, that you would want to get in touch with your manager and make the request, and then your manager can help set that up for you. And they can either set that up through Bryan or Derek or your regular reserve analyst, or through our office as well. All right, another question for Derek. You're just on the hot seat. First, our California HOA has a reserve study every year and on-site every 3 years. First question, can a board use reserve funds in one line item for another line item if needed? What process has to occur to make this legal?
Yeah. So the way funding is set up in California is it's a pooled analysis. So all the funds go into the reserve study and they're not earmarked for any specific component, right? So you're not robbing from one component to pay for another. again, it's a pooled analysis. It's not a straight line. So you can fund for a project.
Second question, doesn't the current board have control over the reserve funds and not the owners when deciding how to spend the reserves for new items?
Yes, it's a board's decision, not the owners.
And third question, in a property that is 40 years old and that took care of all deferred maintenance over the last 10 years through special assessments, there is an argument that only owners who buy in young and stay till old get the benefit of highly funded reserve funds. It's
So
also an argument that the
yeah,
new owners shouldn't subsidize the old owners, but go ahead,
yeah.
Derek.
We we work with active communities like 55 and over, and sometimes they get in the board meetings and they say, "Hey, I'm not going to be here in 10 years. We don't want to fund the roof." It's a good argument that they have. Um, Bryan made some really great points in our presentation today, and that reserve funding is essentially unfair, and the fairest strategy is to set up funds for what you use. So if you live under the roof for 1 full year, you should be paying for 1 full year's worth of that roof. That's the best strategy moving forward.
Thank you, Derek. Either of you can answer this one. How do significant insurance swings affect a reserve study?
I bet Derek has a different answer than I have, because in Colorado, within the last couple of years, we saw increased premiums of like 500%. So what we were actually seeing was homeowners boards were taking reserves just so they could pay for their insurance, so they could be insured. The problem is that I don't know if they actually paid their reserves back. So they basically did a due to, due from type of swap there. But now they're underfunding their reserves. So the problem with insurance is, when's your next insurable event going to happen? Can you guys tell me? No, right? We have no idea when that's going to happen. It's because we don't know it's an insurable event. That's why we have insurance. What did I say about reserves? Reserves are set up for the things that which we know will occur, the things that are inevitable, which are predictable. So insurance is a separate issue from reserves. Now, I do know that some insurance companies, they say, well, our deductible is this. And so some associations are saying, well, we want to make sure that we have that deductible ready to go whenever that issue occurs. But again, that's not your reserves. Your reserves cannot be used for a insurable event. Your reserves need to be taken care of so that they can pay for those expected, inevitable, and predictable expenses that are going to occur. So we would say they're different issues. And we shouldn't be taking money from reserves to pay for insurance.
In California, insurance went up by a lot, probably not quite 500%, but in a 3-year period, and maybe the managers would know better than I, in a 3-year period, I would say 150% maybe. And what it did was, so it's the nature of Bryan and I's business, right? To suggest reserve contribution increases, right? For most associations, they're underfunded. They need to increase their reserve contributions to keep up. But at the same time, you have this enormous pressure from insurance premiums going up. And there's a lot of pressure not to raise the assessments too much, right? Naturally, they have to go up. And Bryan and I tell you, naturally, you have to increase your reserve contributions. But when you have a premium for insurance going up at the same time, the thing that usually ends up getting cut is what's near and dear to Bryan and I's heart, which is reserve contributions. In California, you're also able to borrow from reserves. And what we're seeing a lot of our clients do is borrow from reserves just to keep up and pay their insurance premium. And they're supposed to pay it back. They're supposed to disclose it. But to Bryan's point, it doesn't always happen that way.
Thank you. And there's a question, has AI been incorporated into any phase of the reserve study and analysis? And then how and where?
No, I mean, really, what's interesting about our business is, for at least for me, I mean, I think Derek too. I mean, where we get all our costs and our budgeting costs from, we're calling vendors constantly. I'm calling vendors every single day. We're getting bid proposals. We're researching with manufacturers, just kind of hitting the phones, trying to get pricing updates. Now we use software, so potentially some places in the software there could be AI utilized. I'm not privy to that. But as far as the actual way we do reserve studies, it's still unfortunately a lot of time on a property. So again, we go to a property, we take pictures, we take notes, we take measurements. All that is going to be done with tools that we utilize on site. We then go back, we're crunching the numbers, we're pricing out the data, and then we're creating the reserve study, the PDF report to send to you all. The whole process is a relatively manual process.
Thank
Reporting,
you.
and once we gather the data, it actually takes us a lot of time. I think clients don't completely know and understand that, but there's a lot of information that we have to get into our systems and shape it in a certain way to make sure that it's useful tool, useful map for the clients. I would say that it takes more time to do the report formatting than it does to actually do the inspection. I don't know if you're finding that same thing, Bryan.
It takes a long time. Yeah. I mean, that's the thing. Roger, I believe it was Roger. If you have some tips for me on AI, please just shoot them over to me. I'll give you my contact information again.
Thank you. If an association experiences a high cost event that depletes reserves significantly, like a slope failure, at what point do you recommend a special assessment versus raising assessments significantly to bring the funding level up over a longer period of time?
So I'll say it depends. Is the project happening right now and do they have the cash? They may not have another choice. Derek?
Yeah, no, I think it depends is the right answer. So first we try to fund reserves with regular reserve transfers. If you can't successfully do that, even with increases, then you have to special assess.
What is the legal liability of changing reserve study results? For example, pushing out replacements.
So the U Planet, if that's what that's regarding, I'm assuming that question is regarding the U Planet.
I think it's more like the board members within their discretion determining that a useful life, a component could be 10 instead of 5, something like that. Are they taking on liability?
So I'll
We
say it
don't.
depends, right, Bryan? It depends on what the component is. They call me and they say, hey, the clubhouse, we're not going to remodel it. No one even goes in there and it has zero remaining useful life. And then I make the argument, the clubhouse is from the 70s. It still has shag carpet in it. You need to redo it. And they say, come on, Derek, we're not going to do it. Can you push it out 2 years? I think their liability exposure is close to zero on that. But at the same time, if they call me and they say, our fire alarm system is at zero remaining useful life, I'll tell them, hey, it's 20 years old and that's the life cycle on a fire alarm system. And they'll say, push it out. And I'll say, no, we cannot push out a fire alarm system. It's fire and safety. You need an independent third party expert to come out and let you know that that has additional remaining useful life. I'm not a fire expert, but that's a component that you can't push out. And if you forced me or if you as a board change that number and put that out to the membership, then I would say your liability is much higher.
And I think they would have the requirement to disclose that deferred component in the budget disclosure process, at least for California.
Yeah.
What is the legal liability of changing? Oh, I just said that. Sorry. Our HOA has multiple cost centers due to different home types, and one center is over 100% funded, while others are highly underfunded. How do you typically advise clients to handle that? I think you kind of addressed that, but if you want to say it one more time.
Yeah, it's pretty common in California to have like a master community with some subs in it, different types of condo buildings and some townhomes and some single family homes. So each of those pockets of homes are responsible for different types of items. And so it's important that you have separate reserve studies for each of them. And the funding levels will be different. It's common. And they actually usually have different boards too. Sometimes there's a master board, but maybe the subs have their own boards or their own committees that make the decision. So that's a common thing. And you need a different strategy for each of those cost centers and the funding itself.
How does a board determine a repair expense should come out of the annual budget or should be a reserve expense?
So that's that bucket that we showed where we go, okay, if we have an expense, is it greater than 1% of the total annual budget? Is it a recurring expense? Does it meet the definitions of a reserve expense? then we'd say it's best to be handled from reserves. If it's a one-off or a one-time expense. So the example that I utilized was something like concrete, where we have like either a tree root damaged, a piece of concrete. It's less than 1% of your total annual budget. You can go ahead and just handle that from operating. Or if it's just a one-time expense that's relatively small, go ahead and handle that from your operating budget. But if it's a predictable expense, we would say handle it from reserves. However, there's also non-predictable events that occur. Let's just say a sewage pipe were to burst. That's not on the reserve study, right? And we can talk. I see there's another question about sewage or pipes. So how do we handle that? If it's not on the reserve study, can we utilize reserves? Well, yeah, I mean, we need to, right? That's why we're saying the future is unknown and unknowable. There's always going to be surprises that occur. Therefore, that's why we want to recommend to our clients, let's fully fund the items which we know are going to fail, because there's always going to be a surprise expense that we did not expect to happen that we need to make sure we have money to take care of, like that sewage or that piping issue that might happen.
There's a new law in California, SB 900, and it addresses utilities, so sewer lines, water supply lines, electrical, and so and there's some requirements to reserve for them, and so maybe historically we hadn't reserved for your sewer lateral, and now we're adjusting the study, living, breathing document. We're adding these components and some funding, at least for inspections. But once we understand what the problems are, what the scope is, then we can actually add a component to take care of these sewer lines, the sewer issue.
Thank you. Our board was advised that we could fund reserves through the revenue ruling 70604, but I don't think that is accurate. Please advise. Well, revenue ruling 70604, I believe, is where the association can choose to take the gains from their operating budget and either disperse them to their members or apply them to their reserve contribution at the end of the year. So if you understand the same, Derek and Bryan.
I unfortunately don't, but I try to encourage better reserve funding. So if you have excess operating funds and you want to roll them into reserves, then I would suggest that.
Yeah, absolutely. Jeremy or Michael, did you have anything to add to that before I close this one?
I agree with you, Kristen. I think my interpretation is going to be closely aligned with yours as well, using the IRS ruling 7604 and applying any excess revenue to next year's offsetting assessments in one way or another. And that's defined by the ruling itself. So I agree with what your assessment is, Kristen.
Thank you. We have a challenge determining when a major repair should be in the reserves or in the operating budget. What parameters should we consider? Well, I know, Bryan, you already pretty much addressed that and just a little bit ago. I don't think you missed any portions of that, so I'm going to close this question. Michael, if you feel like it wasn't a sufficient answer, feel free to go ahead and pop it back up. The next question is, since this is recorded, will participants receive a copy that they can share with their other board members? Yes, absolutely. You will in just a couple of weeks. What if the special assessment was spent not on the special assessment not on what the special assessment was earmarked for in California? Good question. That's not a Derek or Bryan question. Let's see. Who wants to take it? Michael? Jessica wants to do it, I think. Unless, Michael, do you want to do it?
I'll let someone in the California market. I'm a little rusty. It's been 5 years.
Okay. I saw you raise your hand, Jessica, to answer that. So you're up. What if the special assessment was spent not on what the special assessment was earmarked for? She's like, I can't unmute. Okay, let's try this again. Go ahead.
That's a Jeremy question.
Oh, punted.
All right, so let's take this one. Let me take the technical way to respond to this is you should seek legal advice from your attorney on, how the funds were spent so that it'll put the association in the most defensible and appropriate direction post those funds being spent. I think you may be running afoul by spending it on something that what it was not earmarked for. But it would really be defined on, the language in the balloting material that was sent to the membership and what they were approving it to be spent on. So something we'd have to dive a little bit deeper in and dissect a little bit more to really kind of give you a definitive answer on that. But I also think this is a very difficult subject that could have some unintended consequences. So seeking legal advice on this, if you really do think you've run afoul of the law here, is going to be the appropriate thing to do.
Absolutely. Thank you. What if the board did use almost all the reserves for a huge hike in California and have not been able to replace them?
Like Mount
Replace the
Whitney,
reserves.
is that where they're going?
I think they used all their money and then they pretty much are at zero funded.
Mine would be a little punny on that. Wanted to go on a hike to Mount Whitney. Yeah, you have to work with your reserve analyst and reevaluate what your reserve transfers should be moving forward. So we talked a lot about reserving or saving today, but we didn't touch as much on spending. You're setting aside these funds to actually spend for projects, and it is common to have clients with a real need for expenses really, really quickly, and actually spending the money is an okay thing, because what happens is you reset the remaining useful life of these components, and the fully funded balance adjusts. Sometimes it even goes down. More often than not, it goes up, but oftentimes, or sometimes it can even go down, especially after you take care of a lot of expenses. So the short answer is work with your analyst to reevaluate what your funding levels are and what your funding levels need to be moving forward.
Thank you. I always hear people say, your job is to spend the money. And of course, save it. So is there a formula that will give the money amount needed to be funded by unit per year to reach a certain percent of fully funded over a specific number of years so that the community to discuss following this plan? That's a really good question. What is the formula, the percent funded formula, and how do you calculate it?
Yeah, so that was, if you remember, like the blood pressure picture, right? I try to use visuals, but your numerator is what's your reserve account balance as of the fiscal year start date divided by your fully funded balance, or I refer to it as your accumulated value of deterioration. That then is your percent funded, but then our recommendation for your reserves is going to be part of that. It's not completely driven by that, but part of it will show you, depending on if you're poorly funded, you might need to catch up. So therefore your reserve transfer recommendation is higher. So then what you could do is just divide that by the number of units in your association. That's going to give you your per unit basis, like how much dollars per unit. And so that's where I came up with that $3 to $5 per day, was just taking our average reserve transfer for the average associations that we work with, dividing that by the number of units on a daily basis, because there's about 30 days per month on average. And that's how I got that daily figure.
California
Perfect.
reserve funding disclosure, there's actually a question and answer what the average reserve deficit is per unit. So it's just an average. If you guys have different assessment levels based on square footage or number of bedrooms or whatever, it's not going to break it down that granular, but there isn't a figure on that disclosure that has to go out each and every year. And the way they wrote it, it was the deficit, because they know and understand that the majority of community associations are actually underfunded.
As a follow-up to the slope question scenario, if the association was funded enough to cover the slope repair and it was a one-time major expense, should they deplete their reserves with the expense? Or, since it's a one-time occurrence, is an assessment a more strategic way to go?
Depends, huh, Brian?
Yeah, I'm so sorry, Susan. But it really is hard to say. I would say the same thing. It just totally depends, because when we say deplete the reserves, as we've been trying to discuss, when you spend money on reserves for a project in the reserve study, your fully funded balance for that project will decrease. But if it's a one-time expense like the slope or grading issue, you would kind of need to see what the reserve study says. Like if you're going to do the project, let your reserve specialists know. We can include it on the budget because if you're going to spend it from reserves, and you can actually see, does it actually deplete your reserves? Are you in the red or are you still in the black? Or you could utilize the UPlanet software and just test it yourself. But it's not one of those things where we can just say, yeah, it'll be fine, or no, you shouldn't do that. It really is like we don't know the answers until we actually run the numbers. And that's why it's so helpful. And I know that's not the answer you wanted, Susan. I'm sorry.
I mean, it can't be super clear anyway. When you take a loan from the reserves, that's something that has to be agendized. The board needs to vote on that strategy. And then you also need to come up with a repayment plan to the reserves. And usually you have to repay that within 12 months. Am I correct on that, Jeremy? I might have missed a step. Thank you.
You give a thumbs up. Yeah.
All right. We have general item for 20,000 every 5 years for general plumbing plus operating plumbing. I think that was just a follow-up to the prior. Should a board use the same company for reserve study year after year? When should the board change the company that does the study?
The element is it depends. Like, did they do a good job? Did you enjoy working with them? Was the process easy to like work with? I think that's really helpful. What we find is that the data that we're putting in the reserve study, if you go from one reserve study to company to the next, the actual like the numbers should hopefully be relatively similar, right? If you get a roofing bid, that roofing bid should then correlate to either reserve study company. What we find the differentiator is the education piece, because the numbers is one thing, but actually educating and empowering your boards to make proper decisions, that's a whole another thing. And we find that that's another skill set. So if you're struggling in that area, I would reach out to a reserve study provider that can help you in that area.
Yep, partner with your manager on that. Roger had some follow-up for you on that, Brian. And then I'll move to Darius. On the special assessment, it was only board approved only. That was just a follow-up. Final question. If an association requires a loan, is it safe to assume that the lender would require a lien on the common areas? It's not safe to assume that.
No, they can't lean. They can't put a lien on like the pool, but from my understanding, and maybe the managers have some input on this, there's very few HOA loans that default. It's a really conservative lending kind of process.
And I see the liens going two ways. Jeremy might have seen it other ways. Either they lien each individual unit for their portion of the loan, or they don't lien the reserve fund, but they essentially own the reserve fund. Jeremy, can you explain that? Because I did not do that very well.
Yeah, you're hitting it pretty well on the head. They'll lien the individual property owners, or they'll lien the association's assets, which do include the association's reserves.
Thank you. Well, one more. Let's see. For a 40-year-old property, do you recommend an in-person inspection by the reserve analyst annually or every other year rather than every 3 years? That's a good question. Like an on-site site study every single year. It's not required, but if you're finding a lot of changes.
Yeah, I mean, we would recommend just if you're on site once every third year seems to be sufficient with no site visits in between those years. But I have worked with clients who say, no, we actually want you to come out because they're making massive changes. They're doing a phased project where there's big changes going on. And so we can work together to create a better kind of bid proposal for our services that understands that that's going to be an on-site every single year. It's just, everything is customized to the client's needs.
Thank you both so much. I'm going to send it over to Jeremy.
All right. Thank you so much, Brian, Derek. Amazing presentation. Learned a lot from it, got a lot of information out of it. So thank you both for your expertise. Obviously, you guys are stately pillars in our industry. So thank you for your dedication and what you do to our industry to keep it great. Thank you, homeowners, board members, for being here tonight. I know it's important to set some time aside, but not always convenient. So thanks for making that a priority and spending it with us this evening. Michael, I'll hand it over to you for anything else.
Really just echo your sentiments, Jeremy. Brian, Derek, you guys have always been great partners. We appreciate you being here, and helping us and our clients become more educated in this field. So I appreciate it. And to all of our board members and committee members here, appreciate you taking time out of your day to be here as well. So thank you all. And Kristen, great job moderating.
Oh, thank you so much. You will get a feedback survey in about an hour. Please, please take it. We make these programs based on your feedback, especially for topics. So we definitely want you to take those feedback surveys. Thank you, everyone, for your extra time that you've given us this evening. And for our Northern California folks, we hope to see you at our upcoming board member conference on July 29th. Have a wonderful evening. Thank you all. Good night.